In today's video, we are breaking down a powerful interview with Tom Lee from Fundstrat, where he explains why gold's recent surge may actually be bullish for stocks. I'll play the CNBC clip first, then give you my own reaction and breakdown, followed by an in-depth look at two AI stocks I believe are strong buy and hold plays for the next 5 years. Hit the like button so we can push this video out to more people, share it with anyone who is serious about investing, and leave your thoughts and questions in the comments below. And make sure you subscribe to the channel so you do not miss the next important financial market update. Now let's hear what Tom Lee has to say.
Here to discuss it all is Tom Lee. He's Fundstrat's head of research and a CNBC contributor. I kind of want to start, Tom, with what's been going on in the metals, because a lot of people are pointing to this and saying the dollar's collapsing and metals are soaring, and should they feel good about owning stocks in this environment, or you hold your nose? I mean, like, can you kind of just unpack for us what you think is going on here?
Yeah, I mean, I think metals is proving to be a real genuine asset class, because I think for many years, maybe people thought only gold bags should own gold. But now, especially the last 3 years, metals have, I think, proven to be a bit of a juggernaut. And it's hard to tell how much of it is geopolitical uncertainty, dollar and currency weakness versus dovish central banks. But maybe if it's all three, that explains why gold's done so well. I don't think that those are bad for equities, because if this is anticipating dollar weakness or more dovish moves by central banks, then it's good for asset prices. So I almost think the gold move could be sort of a glimpse into sort of risk appetite growing for stocks.
As a result of things like dollar weakness and everything else, right? This idea that you go into more riskier assets or ones that are diversified away from there. If you're going to look at that, though, with the dollar weakness intact, Kelly also mentioned the Mag 7 stocks and the slew of earnings we've got coming up. Weaker dollar has typically in the past, from a conventional wisdom standpoint, meant better for large multinational companies. It helps their overall revenue profile, especially outside the U.S. Is that still something that we want to look towards as a true tailwind for this market, other than just saying maybe risk assets are in vogue and we just want to play the AI trade ad nauseum for the rest of this year?
Yeah, I mean, in some ways, I think one of the big sort of real stories this year is earnings growth is accelerating. And that was because of onshoring, the tariff headwinds disappearing. But now if we have dollar weakness, I think it puts more upside to the earnings story. Investors aren't necessarily paying for that right now because multiples have been compressing, but I think it really helps anchor stocks. So between now and the end of the year, I think there can be a lot of reasons for speed bumps, but I think as we exit the year, the earnings story is anchoring, I'd say, upside to our 7,700 target.
Yeah, which is, I mean, we're starting to look at, we've seen one round number after another falling for gold and the likes, and you wonder if we're finally going to get back to talking about S&P 7,000 and Dow 50K and all of that. But so you're not worried there's going to be, you know, kind of landmines hiding in the earnings reports or anything like that? Does the government shutdown matter? I mean, we just had one at the end of the year, and yet here we are with equities. Yeah.
In the short term, of course, shutdowns create uncertainty. And we just, like, as you said, went through the longest one. Those have all proven to be buying opportunities. But it's hard to ignore the fact that gold and silver are like sucking oxygen out of everything.
Yes.
Right.
Yeah. So what do you do with? I mean, Carter Worth, for what it's worth, I want to know what all the technicians, what everyone thinks about this. He's now put out a note and saying, sell all of it, the silver, right? Just sell all of it. I mean, it's up 15%
It's parabolic.
today.
It's parabolic.
Yeah, and
it's just in the last 2 to 3 months.
Yeah.
Yeah. And as you know, like when you look at extensions like this, it's dangerous to fade it because you don't know how long it will go. But you're right. A parabolic move probably marks the end of the move, not the beginning of the move. So it's a good question of like timing. But it sure seems like commodities, especially precious metals, needs to have a place in people's portfolios.
If you look at the way that the earnings story is going to shape up, since you brought it up, if we want to look towards this season, we've kind of established the fact that we're maybe in this transition phase. This earnings season is going to be important, but maybe not as important given the future macro tailwinds that the market may have. In your mind, are there certain key parts of the market that you should be more exposed to? You had in the past talked about banks and financials being there. We saw the run last year, and since the earnings season has started, those banks have kind of sold the news, so to speak. So are the banks still one of those places you want to be?
Yeah. From Fundstrat's perspective, when we did our outlook, our top sector picks this year would be energy and basic materials, and that was from early December. We still like the Mag 7 and financials and industrials and small caps. I think the financials are being buffeted because the White House is choosing winners and losers, and right now they want to reduce the burden on consumers by potentially capping credit card rates and maybe making it harder for institutional buying of homes. So I think this is hurting the banks to an extent. But the bank fundamentals are so good, and I think tokenization and sort of blockchain are really big productivity drivers, and AI is a huge tailwind that I think banks are in the process of re-rating more like tech stocks over time. So, I mean, I would use any of the weakness to buy them.
Tom Lee starts by addressing the turbulence in the market and immediately grounds it in earnings season. This is an important point because a lot of investors panic when they see sharp one-day sell-offs in high-profile names and assume something is fundamentally breaking. Tom is basically saying that volatility around earnings is normal, especially when stocks have already had big runs. He uses Intel as an example, and I think this is where context really matters. If a stock is getting hit after earnings but it was trading at a fraction of today's price a year ago, then a pullback is not automatically a red flag. In my view, this is a reminder that markets punish expectations, not just results. When expectations get stretched, even decent earnings can lead to sharp declines. As the conversation shifts toward the upcoming mega-cap earnings, Tom makes it clear that he still likes the so-called Mag 7 and the mega-caps because they have strong earnings visibility and durable business models. However, what stood out to me is that he does not sound as singularly focused on them as he was in prior years. That subtle change matters. He acknowledges their strength, but he also emphasizes that his top sector calls this year are energy and basic materials. To me, that signals a broader market mindset rather than a narrow tech-only trade. When he explains why he leaned into energy and materials, his reasoning is very much rooted in mean reversion. He points out that these sectors had underperformed for 5 years at levels that historically have marked major turning points. Essentially, the bad news was already priced in. Even if fundamentals are just okay, the stocks can still do very well. I personally agree with this framework. Markets often reward what goes from hated to merely acceptable. You do not need perfection for strong performance when expectations are already low. The discussion then moves into small caps, and this is where Tom's longer-term thinking really comes through. He reminds viewers that when small caps finally turn, they tend to outperform for many years, sometimes even a decade or more. He draws a parallel to valuation levels seen in 2001, which marked a long runway of relative outperformance. This is not about a quick trade, it is about positioning for a cycle. I think a lot of investors underestimate how powerful these regime shifts can be because they are so conditioned by what has worked recently. Tom ties the small cap story to the Federal Reserve potentially turning more dovish. Even without immediate rate cuts, a shift in focus away from fighting inflation and towards supporting the job market changes the backdrop materially. From my perspective, this is one of the more nuanced points in the interview. A dovish tilt does not require cuts tomorrow. It simply requires the Fed to stop being aggressively restrictive. That alone can unlock broader market participation beyond the largest names. When the conversation turns to the Fed chair discussion and the possibility of Rick Ryder being the next chair, Tom frames it through market credibility. His point is that markets need to respect and understand the Fed chair, and someone with deep market experience can communicate effectively not just with policymakers, but with bond investors as well. Whether or not Reader becomes chair, the larger takeaway is that leadership transitions at the Fed matter, and markets tend to test new leadership. This leads into one of the most important parts of the interview, which is Tom's acknowledgement of potential turbulence later in the year. Even though he is widely seen as bullish, he openly discusses the risk of a mid-year drawdown. He compares the setup to last year where earnings growth was solid but markets still had to navigate major transitions. One is a new Fed leadership, which markets historically test. The other is policy uncertainty, especially around tariffs, and the government being more deliberate in picking winners and losers. I appreciate this part of his commentary because it balances optimism with realism. In my opinion, this is where many investors get caught off guard. They hear a bullish outlook and assume a straight line higher. Tom is clearly saying that even in a constructive earnings environment, you can still get sharp pullbacks. Those pullbacks do not invalidate the longer-term thesis, but they can be painful if you are not mentally or strategically prepared for them. Overall, my takeaway from this interview is that Tom Lee is not abandoning his bullish stance, but he is broadening it. He is looking beyond just mega-cap tech, leaning into cyclical sectors that have lagged for years, and positioning for a more inclusive market where small caps and equal-weight indices can shine. At the same time, he is warning that transitions at the Fed and in policy can introduce volatility, possibly even a meaningful drawdown. For me, this reinforces the idea that this is not a market to be all in on one narrow theme. It is a market that rewards diversification, patience, and the ability to see volatility as part of the process rather than a signal that everything is broken. Tom's message is essentially that the opportunity is still there, but the path is unlikely to be smooth, and investors who understand that will be in a much better position than those expecting a straight-line rally. First up is Constellation Energy, ticker CEG, the largest producer of carbon-free energy in the U.S. This company is at the heart of America's clean energy transformation, quietly powering millions of homes and businesses with a focus on reliability and sustainability. In a world racing away from fossil fuels, Constellation is already the leader, with a massive fleet of nuclear, hydro, and renewable assets. Their energy mix is not just large, it's diverse, giving them flexibility and resilience as the grid evolves, but their infrastructure is nearly impossible to replicate. Building a nuclear plant takes decades and billions. Constellation already has them, generating cash for decades to come. These are not just power plants, they're long-term cash machines, protected by high barriers to entry and strict regulations that keep competition at bay. Here's where AI comes in. Constellation uses machine learning to forecast energy demand, optimize plant operations, and predict maintenance before failures happen. Their digital transformation is real, not just a buzzword, and it's making their operations smarter and more reliable every year. This isn't hype, it's a real edge. By squeezing more efficiency from existing assets, they boost margins and cash flow without massive new spending. Every percentage point of efficiency gain translates directly into higher profits and a stronger competitive position. Now think about the AI boom. Every new data center from Google, Amazon, and Microsoft needs a huge, reliable, 24/7 source of clean power. These data centers are the backbone of the digital economy, and their appetite for electricity is insatiable. They can't just plug into coal, they need what Constellation provides. Nuclear power is perfect for data centers, always on, carbon-free, and scalable. As AI workloads grow, so does the need for uninterrupted sustainable energy, and Constellation is uniquely positioned to deliver. Constellation is already signing long-term contracts with tech giants, locking in predictable growing revenue. These deals aren't just for a year or two, they often stretch a decade or more, providing stability and visibility that's rare in the energy sector. This is the ultimate picks and shovels play. Instead of betting on which AI software wins, you're investing in the company powering them all. No matter which tech giant comes out on top, they all need Constellation's energy to keep their servers running. Data center energy use is set to triple by 2030. Constellation's head start and irreplaceable assets put them in pole position. As the digital world expands, so does their opportunity, and they're already scaling up to meet this demand. Their cash flow supports both reinvestment and a growing dividend, recently initiated and likely to rise as new contracts kick in. Investors benefit from both capital appreciation and a steady stream of income, a rare combination in today's market. You get a leader in a critical industry, a direct AI tailwind, and a commitment to shareholder returns. It's a blend of growth, stability, and innovation that's hard to find elsewhere. Yes, there are risks, execution, regulatory changes, and the complexity of running nuclear plants. The industry is heavily regulated, and safety is always a top concern, but Constellation's experience gives them an edge in navigating these challenges. But Constellation's decades-long track record and high barriers to entry make it a fortress. Their assets are essential, physical, and built to last, providing stability and predictability rare in tech. In a world of digital disruption, their infrastructure is a bedrock. Combine that with the explosive growth from AI-driven demand, and you have a unique investment upside from the tech shift, downside protection from infrastructure. It's a rare case where the old and new economies work together, creating a powerful synergy. Constellation is a core holding for anyone seeking growth and income from the AI revolution. It's a foundational piece for a future-focused portfolio, offering both security and upside. The growth comes from data centers, the income from reliable cash flows, and a rising dividend. As more companies digitize, the demand for Constellation's power will only accelerate. Don't overlook this one. While others chase the next AI software, real wealth is being built by the companies powering the entire ecosystem. The infrastructure behind the scenes is where the most durable value is created. Constellation Energy is at the top of that list. Their leadership in clean energy and their strategic partnerships make them a standout in the sector. You don't need to understand neural networks, just know that AI needs massive power, and Constellation is the #1 clean provider. Their role is simple, but absolutely essential to the future of technology. It's a simple, powerful investment thesis. The market is just waking up to this story, but we're still early. There's significant room for growth as more investors recognize the opportunity. Quality companies with this kind of moat rarely go on sale, but the long-term growth here is just beginning. As the world electrifies and decarbonizes, Constellation's value will only increase. Management is focused, disciplined, and committed to shareholder value. Their strategy is clear: invest in the future, reward shareholders, and maintain operational excellence. The regulatory environment is a tailwind, not a headwind. As clean energy demand grows, government incentives and public support are aligning with Constellation's mission, creating even more opportunity. This is a business built to last and compound wealth over time. With every passing year, their assets become more valuable as the world shifts to clean energy. When you look at Constellation Energy, what immediately stands out is how the market is valuing its role in the future of power generation, especially as demand from data centers and AI-driven infrastructure continues to accelerate. The company carries a market capitalization of $104.72 billion, with a price-to-earnings ratio of 33.11, reflecting strong investor expectations for future growth. Earnings per share sit at $8.73, while revenue for 2024 reached $23.56 billion. Net income came in at $3.74 billion, which shows that Constellation is not just a growth story, but a profitable one. This combination of scale, earnings power, and strategic positioning in clean and nuclear energy makes it a name many investors are watching closely as AI energy demand ramps up. If you want a smarter, safer way to play the AI boom, Constellation Energy is a must-watch. It's a rare opportunity to invest in the backbone of tomorrow's economy. That's why it's my first pick for AI-powered energy growth and dividends. The combination of innovation, scale, and financial strength is unmatched. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Next up is Duke Energy, ticker symbol DUK, one of America's largest and most stable utility companies, and a name that's been quietly powering millions of homes and businesses for over a century. If you're looking for a stock that combines reliability, growth, and a front-row seat to the AI revolution, Duke is a top contender. Duke serves more than 8 million electricity customers and 1.6 million natural gas customers across 6 states in the Southeast and Midwest. As a government-sanctioned monopoly, Duke doesn't have to worry about competitors swooping in to steal market share. Their service areas are protected and their customer base is locked in. If you live in Duke's territory, you get your power from Duke. No shopping around, no switching providers. This regulated monopoly model creates a wide economic moat and ensures steady, predictable cash flow year after year, regardless of what the broader economy is doing. For decades, Duke has been a favorite among dividend investors, thanks to its consistent payouts and defensive business model. But today, there's a new growth engine powering Duke's future, the clean energy transition, and the explosive demand from AI-driven data centers. Duke is investing billions to modernize its grid, expand solar and wind generation, and build out battery storage. These aren't just nice-to-have upgrades. Regulators actually approve these investments, which means Duke is guaranteed a return on every dollar it spends. That's a rare advantage in the business world. Their $73 billion 10-year capital plan is already underway, driving 5 to 7% annual earnings growth. A strong rate for a utility of this size. This long-term plan gives investors visibility and confidence, and it's backed by real infrastructure projects you can see taking shape across Duke's footprint. Artificial intelligence is making Duke even more efficient. They're using advanced AI analytics to predict outages before they happen, pre-position repair crews, and restore power faster after storms. This not only cuts costs and improves reliability for customers, but also helps Duke meet strict regulatory standards. AI also plays a crucial role in balancing supply and demand as more renewables come online. By analyzing real-time data from wind and solar farms, Duke can maximize clean energy use, keep the grid stable, and reduce reliance on fossil fuels, all while meeting growing customer expectations for sustainability. But the real AI kicker? Data centers. North and South Carolina are rapidly becoming major data center hubs, thanks to affordable land, reliable power, and a business-friendly climate. Duke is the only electricity provider in these regions, so every new data center that gets built means a massive, long-term boost in demand for Duke. Each new data center is like adding a small city's worth of electricity demand overnight. Duke gets all of it, with no competition. This surge in demand accelerates their growth, justifying even more capital investment and further locking in future returns. Regulators are likely to approve new projects to support this demand, since reliable power is critical for economic development. That means more guaranteed returns for Duke and more stability for investors. The result? A stable, regulated business model that's now supercharged by AI-driven demand and the clean energy transition. Duke is evolving from a slow-moving utility into a growth story with real momentum. Duke's dividend is not only attractive, but it's also growing, supported by rising earnings and a robust capital plan. For investors, that means a steady income stream you can reinvest for compounding returns, or simply enjoy as reliable cash flow. Of course, there are risks, mainly regulatory changes and interest rate fluctuations, but Duke's strong relationships with regulators and the likelihood that interest rates have peaked make these risks manageable for long-term investors. The world needs more electricity, and it needs it to be cleaner. AI is pouring fuel on that fire, driving up demand and accelerating the shift to renewables. Duke is perfectly positioned at the intersection of these powerful trends. For risk-averse investors who still want exposure to the AI boom, Duke offers a conservative, reliable way to participate, without the wild swings of high-flying tech stocks. Think of Duke as the bedrock of an AI-themed portfolio, stable, income-generating, and now with a powerful growth accelerator that could drive returns for years to come. While tech stocks can be volatile and unpredictable, Duke offers steady returns, lower risk, and a clear path to long-term wealth, making it a great complement to more aggressive growth holdings. The combination of monopoly power, massive clean energy investment, and surging AI-driven demand makes Duke a compelling buy for the next decade and beyond. It's a classic get-rich-slowly stock, with an AI-powered boost that could make the ride even smoother and more rewarding. With a market capitalization of $91.32 billion and a price-to-earnings ratio of 18.49, Duke trades at a more conservative valuation compared to some of its peers. Earnings per share are $6.35, supported by solid revenue of $30.35 billion in 2024. Net income reached $4.4 billion, highlighting the company's steady cash flow and reliability. Duke Energy's strength lies in its regulated utility model, which provides stability and predictable earnings, making it a potential anchor stock for investors looking to balance growth-oriented energy plays with dependable income and lower volatility. 5 or 10 years from now, Duke will likely be bigger, more profitable, and paying a higher dividend. That's a powerful formula for building wealth, especially if you're patient and focused on the long term. Duke Energy, where stability meets growth, and the market is only beginning to recognize its long-term potential in the age of AI and clean energy. If you want a safe, proven way to ride the AI energy wave, Duke deserves a spot on your watch list, and maybe even in your portfolio. Now let's look at our final pick, transition to NextEra Energy. Our final pick is NextEra Energy, ticker NEE, the world's largest producer of wind and solar power. If you're looking for a company at the forefront of the clean energy revolution, it's hard to find a better example than NextEra. Their scale, innovation, and relentless focus on renewables have made them a global leader, shaping the future of how we generate and consume electricity. NextEra is really two companies, Florida Power and Light, a top-tier regulated utility, and NextEra Energy Resources, the world's leading renewables developer. This unique structure gives them both stability and explosive growth potential, a rare combination in the energy sector. FPL provides stable, growing earnings in fast-growing Florida. As millions move to the Sunshine State, demand for reliable power keeps rising, and FPL's efficient operations mean they can deliver electricity at some of the lowest rates in the country. Energy Resources is the growth engine, building wind, solar, and battery projects nationwide. They're not just expanding, they're setting the pace for the entire industry, constantly pushing the boundaries of what's possible in clean energy. Their scale gives them unbeatable advantages. Best prices, operational expertise, and the ability to outbid competitors while earning strong returns. With a vast portfolio and deep experience, they can take on projects others simply can't. This is a business with a massive, durable moat. No one else can match their size or experience. Their infrastructure, relationships, and know-how create barriers that keep competitors at bay. AI is central to their operations. NextEra is leveraging cutting-edge technology to optimize every aspect of their business, from generation to delivery. NextEra uses predictive models to forecast wind and solar output, schedule maintenance, and deploy AI-powered drones for inspections, maximizing uptime and cutting costs. These innovations help them stay ahead of the curve and ensure their assets are always performing at their best. At their scale, these efficiencies add up to hundreds of millions in extra profit. Every percentage point of improvement translates into significant gains for shareholders. But the real AI story is demand. Data centers are driving a tidal wave of need for new renewable projects. As artificial intelligence and cloud computing expand, the hunger for clean, reliable power is only intensifying. Tech giants want 100% renewable power, and NextEra is their go-to partner, signing record contracts for massive new projects. These long-term deals lock in revenue and cement NextEra's leadership in the energy transition. Their growth pipeline is enormous, with years of signed contracts providing visibility and stability. Investors can look ahead with confidence, knowing there's a steady stream of projects in the works. Management guides to 6 to 8% annual earnings growth through 2027, with a long track record of delivering. Their disciplined approach and clear communication have built trust with investors over decades. The dividend is another highlight. NextEra targets 10% annual growth, doubling your income stream in just over 7 years. That's a powerful combination of growth and income, especially in today's market. You get the stability of a regulated utility and the explosive growth of the world's top renewables developer. It's a rare blend that few companies can offer. Last year's interest rate worries created a rare buying opportunity, but with rates stabilizing, the focus is back on long-term growth. Investors who took advantage of the dip are already seeing the benefits. Risks, execution, regulation, and supply chain hiccups, but NextEra's scale and experience help them manage these better than anyone. Their proactive risk management and deep industry relationships give them an edge. NextEra checks every box. Durable advantages, secular tailwinds, and top management. Their leadership team is widely respected for its vision and execution. Investing in NextEra is a bet on the future of energy, and the companies leading the transition will be rewarded. As the world races to decarbonize, those who can deliver clean, affordable power at scale will shape the next era of growth. Predictable earnings growth and a fast-growing dividend offer a clear path to double-digit returns. For long-term investors, that's a compelling formula for wealth creation. This isn't a stock to trade, it's a stock to own, reinvest dividends, and let compound over time. The power of compounding, especially with a growing dividend, can be transformative for your portfolio. The AI-driven demand for clean energy just adds fuel to an already powerful growth story. As technology and sustainability converge, NextEra is perfectly positioned to benefit. The company has a market capitalization of $176.62 billion, making it one of the largest players in the sector. Its price-to-earnings ratio of 26.92 reflects a premium valuation, but one that many investors believe is justified, given its long-term growth profile. Earnings per share are $3.15, while revenue for 2024 came in at $24.75 billion. What really stands out is net income of $6.94 billion, underscoring strong operational performance. NextEra's dominance in renewable energy and its ability to consistently grow earnings position it as a core beneficiary of the global transition toward cleaner power, especially as AI and electrification continue to drive demand higher. For investors seeking growth, income, and leadership in a critical trend, NextEra is a must-own. It's a company that not only delivers results, but also aligns with the world's most important long-term themes. The world needs more clean energy, and NextEra is building it. Their projects are shaping communities, creating jobs, and driving the transition to a sustainable future. The AI boom is accelerating their growth. As more industries electrify and digitize, the demand for NextEra's solutions will only increase. NextEra Energy, a long-term compounder of the highest quality, and a cornerstone for any forward-thinking investor's portfolio. There you have it, 3 ways to invest in the biggest energy tailwind of our time, the AI revolution. Constellation Energy leads in clean, always-on power for data centers. Duke Energy offers regulated stability and AI-driven growth. NextEra Energy dominates renewables, capturing surging demand. Each offers a unique blend of growth, income, and stability, but all are essential to the AI boom. Instead of betting on the next tech winner, invest in the toll roads powering them all. Which company do you think has the strongest long-term edge? Let me know in the comments, and don't forget to like and subscribe for more investing ideas. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Thanks for watching. See you in the next one.